This podcast is entertainment, not financial, tax, or legal advice. Views expressed represent statements of the speaker in their individual capacity, do not represent the views of Unchained, and should not be considered investment advice. Speakers often have personal, family, or business connections to Unchained, which may include direct financial benefits. Please see our disclosure at unchained.com/podcast.
Allen, thanks so much for joining us today. How you doing?
I'm doing very well, thanks. How are you?
Doing well. I've been really looking forward to this chat, not just to talk to you about your thought leadership pieces that you've published, but also to learn more about your role as an investor in the Bitcoin space. I find venture capital in the Bitcoin space to be fascinating. Typically, when I think of VC, it appears to be an industry that significantly benefits from cheap and abundant money. Right. So how does a perfectly finite money like Bitcoin disrupt traditional VC?
Yeah, that's a fascinating topic. I like to think I have some coherent thoughts about it. I guess we'll find out.
You just follow the interest rates, and when money is super cheap, VC shoots through the roof. And so imagine a world like on a Bitcoin standard, when that funding is no longer available at such cheap rates relative to what the market might see it as. How does that disruption actually play out, you think, for an industry like VC?
Yeah, that sounds simple. I think we might spend the entire hour just trying to answer that question. My where I initially go with not just this, but I think a lot of questions like this, is to make a clarification that maybe on the face of it seems a bit boring, but I think is actually just honest in a sense, that I don't find the hypothetical future where Bitcoin is predominant to be all that interesting or all that new. What interests me more is the unwinding of the fiat corruption, and in a sense that Bitcoin is to me, it's obviously there are some ways in which it's very sexy and new, and maybe we can get into that separately. But for this and for a lot of the things where frankly I'm have more expertise, I feel like all the novelty is technical, which is in a lot of cases is kind of beyond my pay grade. In the areas where I do have more expertise, it's really just kind of normal. It's like how things should be. And so the end state or the outcome that we're hoping for is just like, yeah, well, everything's just kind of the way you would expect it. And it's not that. It's like plumbing, right? I come back to that analogy quite a lot. No one really cares how, maybe plumbers do, but outside of plumbers, hardly anybody cares how plumbing works. You just expect it to work, right? If it's not working, that's, I guess, maybe horrific. And so, depends how badly it's not working. It might be pretty bad, but it's kind of more interesting diagnosing why it's not working than why it is working, because when it is working, it just works. So kind of getting that out the way. Couple of things I would point to in terms of the setup of how has fiat corrupted venture. I think the most interesting point, for me at least, I mean, apologies if this is just kind of avoiding the question, but what I find most interesting about this overlap is something that you didn't even mention, because I think it precedes it. I forget exactly what you said. I don't mean to be misquoting you, but it was something to the effect of, when interest rates are just artificially low, venture goes through the roof, right? And it's teasing that out that I find to be the most interesting. And I kind of, with the plumbing, I might keep bringing this up actually, just because I've made myself laugh. The most horrifying as well, in terms of like really teasing out what are the mechanics here and what are the incentives and so on. So with fiat, the way I see this working, like what I see the connection as being is best understood at the level of asset allocation to venture. And the relevance, I think, is as follows: that when interest rates are held artificially low, the monetary premia in other asset classes basically gets saturated, right? So this sounds like very technical jargon, but I think most Bitcoiners are familiar with this, that like real estate just becomes monetized. It isn't valued on its, maybe there's a floor in its value on its actual utility, but that's not where it's being valued at the margin. Similarly, equities, bonds, whatever other intrinsically financial asset classes get even more financialized, and they kind of likewise suffer from the same thing, where you can imagine a floor of like the book value of the companies or something like that, or like a very, very primitive DCF of their with their cash flow, what you estimate their cash flows to be, but then you have weird questions about what discount rate are you even using, what makes sense. So, it's not like these things are worth nothing, but how they're actively being valued is just crazy. And so you compare that though with where in our current system, where the vast majority of these capital allocation decisions, at least at the very high level, like deciding what asset classes to allocate to, not necessarily what individual investments within the asset classes, it's predominantly pension funds of some or other variety. And it's almost entirely being managed by intermediaries, effectively, right? It's people who have a fiduciary responsibility to the ultimate beneficiaries of the pension plan. Like, this is the vast majority of, I mean, even wealth in capital markets, never mind kind of specifying it more. And the problem they have in that situation is that when this has gone on for long enough, this monetization process of these asset classes, you can't really make a reasonable argument any longer that they will continue to benefit from appreciation, because so much of the value is in their monetary premium rather than, the realistic expectation of how well they'll perform as economic assets, which is really, really problematic if you have liabilities that are either already exceeding your assets as a capital allocator, or which, again, I don't want to get too bogged down in the mechanics of this, but which maybe have some kind of, how would you describe it? That, they basically, how they're going to grow, right? Even if you're not technically insolvent now, you will be in the future if you don't meet a given rate of return. So what I've just described is the position of almost all, I mean, the severity of it is to varying degrees, but almost every pension fund in, the West, broadly speaking, is somewhere on the spectrum of being screwed by this. And so finally, like, that's, again, most Bitcoiners, I think, are vaguely familiar with this. Where it comes to for venture, though, is interesting, because venture, very broadly speaking, like nothing to do with Bitcoin, venture is broadly seen as a not completely uncorrelated, but kind of relatively uncorrelated, and far more, far higher on risk and return, like way more out the risk spectrum. So you're intrinsically taking a lot more risk, and even baked into that is the essential illiquidity, which for, again, at that level of capital allocation is seen as a variety of risk because you can't liquidate it, and then returns obviously as well. And so what happens with all of that as the context, if this has gone on for long enough, flows to venture will go up and up and up with no reference whatsoever to the viability of what is ultimately being invested in, because the position of the capital allocators at that very high level is basically, we have X liabilities, we have Y assets, the Y assets are already as monetized as, like, there is no way that we can close this gap without taking insane risks, right? Like, there's no, or maybe they obviously wouldn't phrase it that way, but alternatively, there is no way that, the S&P 500 or whatever other relevant index they have is going to generate enough of a return to close this gap for us. Never mind that the kind of the tragic irony here is that the gap exists in the first place because of this process, right? Like these distorted fiat incentives. So they have to go further and further out the risk curve, and they have to start allocating to venture purely and other similarly, I was going to say stupid things, not to say venture is stupid, but at that point it kind of becomes more and more stupid necessarily, because it's not being dictated anymore by the viability of what's being invested in. The reason my mind jumped to saying stupid is that I would go through this exact same process in explaining why crypto stuff gets funded, for example, because even though it makes no sense, it is plausible that you'll get 1,000x return, right? It's like, and there's a non-zero possibility that if you scam enough people, you'll get 1,000x, whereas the S&P will never 1,000x ever. So you're like, your probability there is zero. And it basically becomes a function of like, how insolvent are you ultimately because of fiat? How many risks do you need to take? that's why crypto even exists in terms of how it's financed at the source. But, that obviously sits within this broader bucket of venture. And so that's the mechanics that I think it's worth understanding. I think just because, I find it intrinsically interesting, but I don't think most people they wouldn't naturally jump to that, if you want to think of it as like supply of venture capital. Most people jump to the demand of venture capital because it's much more accessible. It's more kind of consumer facing. Everyone can readily think of originally venture-backed companies that did very, very well. Depending, is probably not as well known to the layperson, but a lot of venture firms are relatively well known. That part of it is a lot more accessible, and kind of even in terms of the professional roles involved, being a VC is kind of easier to understand and is more normalized in culture than like being an asset allocator at a pension fund. It just seems all very kind of boring and opaque. But you can't understand why it happens without having a view of that of those mechanics. So that's what I like to open with.
Yeah, you mentioned the 1000x returns, and I think that's what people typically think of when it's like the VCs out there. That's what they're aiming for. Like they might have 10 duds and then one grand slam. And I'm wondering if Bitcoin is the money that everyone's using. Does that strategy change? Because the risk might not match up.
I think it does. I think it definitely does. But again, not for the reasons that people would normally assume. And so that's why I wanted to give that context as the introduction, because I think that dynamic you're describing, which is like mildly caricatured, but it's
right.
Not wrong, right? It's kind of, it's correct in type. That sort of becomes reflexively true in a sense as well, because if you assume that, basically what I just said is even roughly accurate, that the dynamics in that situation of prolonged artificially low interest rates via the mechanics I just described ends up being there's much more supply of venture capital than the actual, for the sake of argument, the VCs would not want exactly, because there's kind of perverse incentives there as well, but would prior to those circumstances have argued can be well allocated. If they know why they're in that situation, which they probably will, because they'll be communicating with their own clients, otherwise they wouldn't have the clients in the first place, their incentives then also become, we need to find this 1000x, right? It's not like there's a natural environment of distribution of returns or whatever. I mean, you could argue that maybe there is, even if it's unknowable, but it doesn't just happen spontaneously, right? It is direct. This is the entire point of financial intermediation, really, of any kind. It's directed by, in this case, VCs. And if their incentives coming from their LPs, their clients, which are the capital allocators at the higher level, is like, we're insolvent, we need 1000x's, then that is how the VCs are going to invest. So we can, I think, correct me if I'm wrong, but I think what you were getting at, or maybe what you were expecting me to say, is more like fundamental in the sense of, if we have sound money, do people behave differently? Which I also think is true. But again, it's back to what I said in my kind of introductory comment of like, that to me isn't as interesting or as funny. If we have, that's just like normal. That's how people should behave. It's understanding how all of this unwinds that is, to me at least, more interesting.
Yeah, I think I'm looking at it more. You definitely answered in a way that I think is fascinating. Would love to like continue going down that road. Where I was coming from is thinking, okay, if you have a money that is perfectly finite, and the idea of investment kind of changes,
Mm-hmm.
and what is, am I going to invest in a company that doesn't touch my life at all, or am I going to invest more locally? Am I going to invest in things that...
Yeah, that's a really interesting one. I didn't think you'd bring that up at all, but we can come back to that for sure.
Yeah, and more like, kind of more mission oriented investment as opposed to like trying to make more money. Because your money itself, just holding your money simply, can be good enough if it's a finite money.
Yes. Yeah. Okay. There's a few things there. I'll try to tease them out because they're probably all worth individual discussions. I don't want to get lost. I should maybe even just be taking notes actually. So one is this point about investing locally. This I think is fascinating. I honestly I don't want to claim like I came up with this. Obviously I didn't because you just said it, but I've had thoughts about this that I don't think I've ever seen articulated. But also I assume other people have as well. So like trying to get that discussion going would be great. And I think it ultimately comes from exactly as you articulated there. That's a perfect way of setting this discussion up, that if you can actually save, right? If you're making this distinction basically between saving and investment, which in the setup I described under fiat are like forcefully conflated and nobody can escape this and it's a nightmare. You can just actually save such that when you invest, you can have more discretion about how and why you're doing it. Yes, I absolutely think you get much more locally oriented investment. So we can come back to that. There's another point that I'm not sure if you were getting at this or not. I sort of expected you to, and I'm sure you'll understand why I'm bringing it up. It actually interestingly touches on what we do at Axiom. So maybe there's more of, to whatever extent you're interested, there's like a practical segue there, aside from all, this just basically being theory, that both the VC and the entrepreneur that is being funded, I mean, basically probably just everybody actually. I think that the decision starts with the entrepreneur and then it filters back through who's funding who else. They're going to be, I think I can't really say this deterministically, but I think it's reasonable to expect that they will be much more prudent in their own capital allocation because they will know that the opportunity cost is just holding Bitcoin, which this I think is sometimes misunderstood because there's a temptation to think of like basically number go up, right? The Bitcoin just goes up forever and you're really denominating all of this in fiat. So like, why would you put fiat into anything other than Bitcoin, basically? Which I think is true. It's not to dismiss that, but I don't want to get too hung up on that that's like a special case in the period of Bitcoin monetizing. There's a more general principle behind that. I think it's important to argue about clearly, because otherwise you risk thinking that, once Bitcoin monetizes, this just goes away. Like this incentive isn't there anymore. And I don't know, maybe we just collapse back into fiat degeneracy, but now we have signed money or something, which I think is very much not the case. I think basically what is happening there, the crucial distinction, which I alluded to a second ago, is between saving and investment. That's exactly the decision that people are making now, by the way, when they say, why would you put, and this is kind of amusing because we face this a lot, we being Axiom, right, as a venture firm that focuses on Bitcoin. By far the most common thing that we'll be asked is, well, why would I invest in you rather than just buying Bitcoin? And our honest answer is, well, you probably should just buy Bitcoin, but these are different things. Like when you buy Bitcoin, you're not investing, you're saving, right? And to some extent, I probably wouldn't say this like to an actual prospect for a fund, but I kind of want to say, if you don't understand this, then you don't really understand Bitcoin in the first place. Like you need to go away and think about this. So I'll say that to your audience, but I would never say that in a professional context. But I believe it. Like I think it's basically true that if you think of Bitcoin as anything other than savings technology, or at least, I mean, maybe you focus on some other element of it, but if you don't agree with that, I'm not really sure what we're talking about. So that's an interesting component there. There's a lot of different directions we can go in.
Yeah, I mean, you talk about the hurdle rate, and that actually was something I was going to bring up, but you are right that it is defined to a period of Bitcoin being monetized. And so I was curious how you make that distinction for your, potential LPs. And
we make a different in that context. We make a slightly different argument because obviously, one is just like manners. I'm not gonna say what I just said in a professional context. But I think there is another subtlety which maybe is only relevant in the precise context of, it's more specific than just do you want to invest versus do you want to save. It's do you want to invest in our fund? Like, do you want to be affiliated with Axiom? Given that we aren't just, well, it's kind of hard to define it in the negative. It's more like we're doing something very precise, right? We're investing in companies that are building on Bitcoin. And so the pitch that we make is as follows, because I believe this, like, I think this holds up. It's just a question of there's more than one step in the logic that I'm about to lay out that I think it's reasonable to disagree with. And so we kind of expect people will sort of fall off as they, you know, as we run them through this, which is okay. And I mean, if it ends in them just buying Bitcoin anyway, then that's still good. They'll probably still do very well out of that. But it's as follows. So, if you believe in what we are doing, you necessarily believe in Bitcoin as well. You don't need to be too precise about what that even means. You don't need to define it in terms of the price necessarily. Like, that's an obvious way of, you know, Bitcoin success, gauging it by the price. Maybe it's some measure of adoption or utility or things that are kind of hard to quantify anyway, but you can leave it at the fairly vague level of like Bitcoin succeeding, right? But you do need to believe that Bitcoin is going to succeed in order to believe in us. And a way I often put it is that there's no world in which Bitcoin fails and yet we somehow do well, right? Bitcoin can do well and we could fail because we just make bad investments, but the inverse can't really happen. It's not reasonable to expect that it would happen. So from that starting point, the question is then, okay, well, you hold that belief. So in that environment, to the extent you want to invest rather than save, how would you go about doing that? Like, what would you be looking for? What would you be prioritizing? And our answer to that, and what we're trying to offer up as a product essentially, is that you think hyper-Bitcoinization is going to happen, which basically means eventually everybody ends up on a Bitcoin standard. Now, the companies that are what we call building on Bitcoin, which again, we can get into that if you like, but that too is deliberately a little bit vague because we don't want to be overly prescriptive before we see the opportunities. But these are the companies that will be building the infrastructure to enable hyper-Bitcoinization, which means enabling others to get on a Bitcoin standard as well. And so it stands to reason that they will probably be the first companies to go on a Bitcoin standard. That's probably the most objectionable step, like where we might lose people, by the way. I think it's if you buy that, then it's plain sailing to the end of the argument. If we are good at identifying the companies that are the first to go on a Bitcoin standard, all that really matters then, and I mean, in some sense, how you would even gauge whether we're good at it or not, is that they will be return generating in Bitcoin, right? They'll be profitable companies, but they'll be on a Bitcoin standard, which almost definitionally means they're outperforming Bitcoin at that point, which is a little weird to wrap your head around because you would never say, in just a broader venture context, you'd never say that a company is outperforming the dollar. You would just say that they're like performing, I guess, right? They're profitable, they're generating a return, they have appreciated. You don't really specify relative to the dollar because you measure everything in dollars. But you have to remember, if we're moving to a Bitcoin context, and obviously we're going to be measuring everything in Bitcoin, and that's kind of the final thing that ties everything together, that even the original question, I would argue, is motivated by pricing things in dollars, basically, because it's kind of implicit. It's like, well, are you going to put your dollars here or are you going to put them here? And again, my insistence would be that you don't see them as alternative investments. You see one as saving and one as investments. But equally acknowledging that we are currently living through, like, hyper-Bitcoinization hasn't happened yet. So you do have to be fairly disciplined about this. And that's kind of the argument that we would make, that it might be, I have to be careful how I phrase it, but that it might be a good idea. We obviously can't guarantee that we're going to outperform Bitcoin. It ultimately, we think that via that logic, it kind of comes down to just, are we good investors, right? Because the rest of the argument is basically a thesis about the environment that we are investing in that makes it a good idea to be looking to invest in these places, but we still need to do well. Like, we still need to identify the companies that do actually perform the best in that environment, do create the most valuable infrastructure, and do bring about hyper-Bitcoinization itself. So that's how we lay it out, and hopefully somebody somewhere believes that.
Yeah, and you got me thinking that you would talk about profitability on a Bitcoin standard. One would anticipate, if they're thinking Bitcoin's, going to continue going up in value, that the amount of profit per year in Bitcoin terms will go down over time, thinking that does that make sense? So as Bitcoin continues to go up in value, the total amount of profit in absolute terms should go down over time, unless you think that they would. The goal is to outperform even the. I guess that technically would be underperforming Bitcoin in that sense.
Yeah, I don't
But
see why it would. I mean, if you're making a kind of a macro argument about effectively what kind of, to the extent you think this is valuable in the first place, which I guess a lot of Bitcoiners wouldn't, but what kind of macro aggregates that it even makes sense to measure, like how would they behave over time? I think what you outlined is probably correct. But on an individual company basis, I don't see why this would be the case at all. I mean, to be clear, we're not arguing that any of our investments will grow forever. And even there, I should be more precise because I've written and spoken a lot about hating some of that terminology. By grow, I don't know to what extent you'll want to get into this, but I kind of just caught myself. By grow, I don't mean that their revenue goes up. I mean that they have positive returns, either in Bitcoin or if in dollars at above the dollar denominated appreciation of Bitcoin. That's what I mean by grow, right? And no company can do that forever. It doesn't make sense because for reasons that are probably quite obvious, but it's sort of made more obvious by the scarcity of Bitcoin that you can't end up earning more Bitcoin than there is. But we don't intend to hold them for infinity time either, so that's okay.
Fair enough. To bring it back to a more kind of like in this moment, not necessarily thinking in the future of hyper Bitcoinization, I'm curious when you think about like investment in the Bitcoin space. This Bitcoin space has an ethos of trusted third parties are security holes, but then how does this impact the ability for companies to like capture and maintain market share and have outsized positive returns?
That's a really interesting question. So I can think of at least two very interesting ways of addressing this. One is a little bit more specific to payments, perhaps. I heard it in a payments context, and I'm not sure how much it generalizes beyond that, but I'll credit it to Parker Lewis, who's obviously a very, very bright guy. I'm pretty sure, I'm not sure if I'm misremembering this, but I think he said this in a talk he gave in Prague. I mean, he talks a lot. He's given a lot of talks. He's written a lot, so I might be misremembering it, but I do know it was definitely him who said it. It could have been on a podcast. I'm not sure. We can fact check this afterward. You just edit this part out.
Fair enough.
But he made this crucial distinction, and obviously he's at Zappright, right, which is like Bitcoin payments company. He made this crucial distinction between I forget how he worded it, but I remember the concept really clearly because it clicked with me as soon as I heard him say it. In like a payment processing role, or I mean, really any role where you're helping a business accept Bitcoin, that doesn't mean that you need to custody it for them, right? And we've sort of lost this in regular finance, I guess, fintech to some extent, although this massively precedes what we would now call fintech, just because of the way fiat works. There isn't really such a thing as a bank or a payment processor or really being involved with the movement of money for whatever reason. It could even be capital markets. It could be a completely different kind of scale and category of why money is moving. You can't really do it without custodying it and therefore to some extent being what you would call a trusted third party. Bitcoin disrupts this in the sense that basically you can custody it yourself. I mean, it's kind of that simple. Not only can you arguably should custody it yourself, but that doesn't necessarily. This is the point that Parker's making. It's really important subtlety that the fact that it's free and open source software, you can custody it yourself. You can also only run other free and open source software to help you do that. But that doesn't mean that there isn't a role for businesses adding value to this process without taking custody, right? And therefore without becoming a trusted third party in the sense that is relevant to the discussion of moving Bitcoin. So that's one point. And I guess to summarize that in slightly more general terms, because I don't want that to sound like it's, only about Zapright, basically. I think it is worth reflecting that this comes from how Bitcoin works as opposed to how fiat works. Like you probably can extend this beyond payments. Now I'm thinking about it. Really, any way of manipulating Bitcoin itself is such that this can be done without, there's no really like a binary of, are you custodying or is, a bank is the trusted third party custodying. There's a spectrum, I suppose, of how involved you are willing for others to be, in particular if they are adding value for you. So that's a really interesting point. That's just not possible with fiat, but it is possible with Bitcoin. The second point, I'm not sure I can remember now. What was the point I was going to make? Oh yeah, sorry. It came from the way you asked the question. I might actually just get you to restate it so I can make sure the answer is pretty focused. You said something to the effect of how do you like lock in customers or something like that? Do you remember?
Yeah, essentially like maintaining market share and eventually leading to like outsized returns.
Yeah. So this is, I think this is maybe the most fascinating part, actually, for me at least, of thinking about the overlap with venture and Bitcoin. Maybe about actually working in this space as well. Now I think about it, because I'm pretty sure what I'm about to say, I arrived at via seeing it, like actually, to some extent. I don't want to overplay my role in this, obviously, but to some extent being part of it in the wild, that there's an unfortunate heuristic that I think this is also, by the way, something that comes out of like, this is a fiat corruption, and just unwinding it gets you to a normal state rather than an exciting state. But there's this unfortunate heuristic in, be a bit more specific than just venture, but kind of Web 2 era software, right? That basically what you need to do is, across a massive range of potential applications, you need to grow, which just means get bigger, not in like a healthy way, in almost a distinctly unhealthy way. Get big as fast as you possibly can with zero concern for what your actual economics are. Get as many users as possible, then lock them in, or in the course of getting them, do it in such a way that they're locked in, right? And then just exploit them after the fact. And that's like, I hesitate a little bit to say that I've obviously characterized it in a very, in a not great sounding way, right? I'm not sure that there's even necessarily an ethical component to this, other than perhaps saying that, this also follows from, it's not even really a fiat thing. It's frankly more of a software thing in an environment without Bitcoin, or at least in an environment which so heavily selects against free and open source software. And I think there's some overlap there. That's maybe a separate kind of philosophical discussion, to what extent does Bitcoin incentivize more awareness of the extent to which what you're using is actually free and open source. And again, I think Bitcoin basically undoes this in the sense that what companies, as I say, building on Bitcoin need to do is not, per that heuristic that was true for, the better part of 20 years or whatever, grow at all costs and exploit their users, but actually just add value, right? Which is like, when you put it that way, I'm being a bit facetious, obviously, but to make the point that it's not that sexy. It's certainly not new. It's like what almost all businesses ever have done, right? They create something that their customers find more valuable than the cost of creating it, right? And also, I think crucially mindful that there will necessarily be competition, especially because everything is so kind of fundamentally rooted in free and open source software, continuously iterating in the value that you're adding. The one point I would end on, though, I know you didn't say this, but it is a common misunderstanding of this line of questioning. That doesn't mean that you can't make any money, right? That doesn't mean that you can't compete in a meaningful way, allocate capital in a valuable way. It just means that this really perverse dynamic that for whatever reason, to whatever extent it is or isn't derivative of fiat itself, everyone seems used to and seems okay with, like, that goes away. And we just return to, can you provide value? which is great. Like, that's how it should be. It's not new. It's not controversial. It's just healthy.
And I guess where I was thinking that you might go, or just something that I've heard in the big, I'm not a VC, but it seems like a question that's asked of, a company is trying to get funding from a VC, and a question the VC would ask is, how do you build your moat? Like, what is your moat you're building around your company in order for there not to be this, like, it's almost like anti-competitive in a sense. Like, how are you going to build a moat so that you don't have to compete,
right?
Just like provide value all the time? So I'm curious, like,
well, I mean, that's
does that question
I don't
just
know
go
how much
away?
Background you'll know, or that your listeners will know, but that's sort of the tongue-in-cheek thesis of 0 to 1. Like, does that ring a bell? That's basically what Thiel says in 0 to 1. He doesn't say it entirely seriously. It's sort of unfortunate that it's often cited out of proper context, or almost misquoted, that he's like, this is the actual advice he's giving. It's more a kind of amusing reflection that basically you want to become a monopoly. That's the quote that's often used. But it's, I mean, I don't want this to turn into like a book review of 0 to 1. It's an amazing book that everyone remotely involved in either, tech or finance should read. But when he says this, he's reflecting on the dynamic that I just described, right? And one way of interpreting what he's saying is basically that you want to first find something that is so different and genuinely unique, like as a product, basically, like what, the point of what your company is. First of all, find something that is so different so that you're the sense in which you're competing is not forcibly undercutting others' returns in something that's like you're contributing to its commoditization and just driving returns to zero. Like, you just don't want to do that. I guess nobody really wants to do that, but that's sort of the natural end state of actually mature industries. Whereas if you're venture backed, and obviously Thiel's primarily known as, I guess, PayPal, but otherwise a legendary investor, you want to find something that is so new and then get such a lead in doing it that it's just impossible to compete with you. Not necessarily because of that dynamic. It does benefit from this, obviously, but not necessarily from the dynamic I described of just exploiting your users having grown at all costs. That's one relatively easy way to achieve it. The real point, though, is that in whatever way this manifests, you are just so ruthlessly competitive that actually it's pointless to try to compete. And that's the essence of, when I'm saying that this is kind of misquoted or misunderstood. He's not saying that you literally shouldn't compete. He's basically saying you should be so good that no one wants to compete with you in the first place. So that's my rant.
And then
0 to 1.
in this world of like free and open source, with Bitcoin being like so paramount because you don't want to trust anybody, the ability for somebody to just see, oh, that company's doing well, let me just go ahead and copy their free and open source software and make it, the same thing. So they're not closing source their actual product, but they're still able to get market advantage,
Yeah.
obviously, by moving
So
faster, but
here
is
I think
that
is a
is
really
that
interesting
a
thing.
concern?
This actually might be what you were getting at originally. So please chip in if you want to get even more specific about this. But I think what's really healthy about Bitcoin and different to it's not even necessarily with reference to that somewhat caricatured dynamic that I described and referred to a couple more times. It's really more just exactly as you said just now. It comes from how intrinsically connected to free and open source software Bitcoin itself is, that there's a different dynamic typically. I don't want to speak in too general terms or I guess to overgeneralize, but some version of the following is almost always true, that you simply can't rely on that dynamic in Bitcoin because it obviously is a product of closed source software, I guess, if you want to call it that. If a company in that, that dynamic, right, that was building per those conditions, both of funding and software and so on and so forth, like all the Web 2 now giants, if they had relied too much on open source software, then what would probably have happened is, I think is what you're alluding to as well, that someone else would have copied that and then made it closed source, and then they'd be the ones that would win because you can't copy them anymore at that point. So what's really healthy about the Bitcoin space is that avenue isn't really available. The dynamic is almost entirely inverted, actually, in that if you are too closed source, which is a worthwhile caveat, by the way, because I don't think you can have absolutely everything be open source. You're kind of begging the question as to whether you're even a company at that point. So you're assuming some of what you're doing is closed source, but there's always a kind of a delicate balance, because if you make it too closed source, someone can copy you by making it more open source instead of by making it more closed source, and that will actually probably, it would depend on exactly what the product is, but that would probably appeal more to users, because they'll basically just start to get suspicious of the too closed source version, because they know, intrinsic. This is right back to actually the example I gave from Parker Lewis, that it is in theory possible that they could just do all of this themselves. They're relying on a business because of the value that's created for them, but it's measurable, right? It's not like it's impossible to get the same end product. It's just a question of basically what they're being asked to pay to compensate for what, the value that they find in it. So that tension, I think, is really, really healthy. And I think the way it manifests ultimately for companies, but from my point of view, for investors, is basically that you need to be very mindful of this. You can't, again, I mentioned this a few minutes ago, that you can't be so open source that you're just not a company, but you can't be so closed source that you alienate your customers and you invite competition in the other direction. And ultimately, it's frankly just consumers who win from this, right? This is kind of Thiel's point. This is, again, not I keep bringing this up again, but this is the sense in which Thiel is sort of, I think he's misunderstood on the basis of, people saying, well, people thinking is literal, I guess, that, ultimately the best investments are just ruthlessly exploiting their own customers. He does sort of suggest this, but in a very tongue-in-cheek way. But the dynamic by which that is even possible doesn't really exist in Bitcoin. So again, the way that, not to suggest that, like no companies can be successful, and by extension, no investors can be successful. There's just a healthier focus that is forced upon companies operating in the space, that they can only create a moat, to use some of the terminology that you used, right? They can only create a moat to the extent that they really are offering value, right? Not that they are locking in customers.
I love it. I love it. I feel like I could keep going so long on VC, but I really wanted to talk to you about the article that you put out earlier this year on your half-baked thesis on stablecoins.
Oh, sure. Yeah.
And
we can come
and I absolutely fascinated by it, and I know that while I would rather be talking about Bitcoin, I feel like this is so relevant. And so I would love to know, like, what's the current state of your thesis? You wrote it way earlier this year, and so I would love to know, the current state of the thesis, and has it evolved since writing the piece?
I don't think it's really evolved. There's one thing I will highlight though, which is a development in crypto, basically. I try to be polite in how I describe the following. That I didn't foresee when writing it. And honestly, I mean, I can't really be that polite. The reason I think that I didn't foresee that, it's hard to know like why you didn't predict something, but I think the reason I didn't predict it is that it's just too dumb. Like I really didn't think that something this dumb would happen, which is that the momentum seemingly has now gone to new blockchains that are for stablecoins. Like they're explicitly and only for stablecoins, which it's just so. I don't know if we have time to explain why that's so dumb, but it's like
you put out a couple articles.
They're running out of ideas. I mean, one of the things I said in the article was, I think this obviously was just wrong about this, right? That they've already run out of ideas. And I've said this elsewhere. I have another article, which I don't know if you've seen, or was originally was actually based on a talk around the historical development of crypto in parallel to Bitcoin, and basically how it's kind of cycling through as many ideas as possible that aren't Bitcoin but are getting closer to Bitcoin, so that they can just keep extracting fees from totally confused clients, which is this is right back to the very first thing we talked about, by the way. That's the the capital allocators who need 1,000x. That's where all that comes from. But I thought they'd cycled through everything. I really kind of thought maybe it was just like naive, inadequately cynical Bitcoinerism. Like, surely they're done with the scams now. Like, what else could they possibly scam people with? But it turns out, yeah, blockchains for stablecoins. So that's new. That was the answer to your question. What's changed since publishing this? That's a thing now.
Yeah, and well, at least in the United States, the Genius Act has passed as well, and so I'm curious if that has had any sort of impact on your thesis at this point as well.
Well, it doesn't seem to have, because as far as I can tell, nothing's actually happened following the Genius Act. I mean, I'm open to being corrected on this. I mean, it's equally not something I pay that much attention to because it's not that relevant to what we actually do. Which is kind of what you sort of alluded to this when you asked the question, right? That you'd rather be thinking about Bitcoin. I mean, we don't have any exposure to anything that would be relevant to the Genius Act. I mean, well, maybe one thing that you might want to get into in whatever time we have left is I'm wary that actually explaining the whole argument of the piece would probably take at least that much time. So I'll basically just jump to the end, sure. Which is the prediction for the very long term. And I really don't know what I mean by that. It could be 5 years, could be like 50 years, who knows? But that to whatever extent stablecoins remain a thing, I think eventually they will have to route over Lightning. I think Lightning will be a kind of a clearance or a settlement network, hopefully for not just stablecoins, hopefully mostly for Bitcoin. And there's maybe an interesting discussion to be had about other nascent L2s kind of plugging into Lightning, Roy Scheinfeld's whole thesis there. But for stablecoins in particular, the only way that they can scale, assuming that they even will, maybe they won't, but if there is a concerted effort that goes on for long enough to try to get them to scale, they will have to be settled over Lightning for pretty intrinsic technical and economic reasons. Probably the first step there is either taproot assets or RGB as the tokenization scheme or MET protocol, whatever you want to call it. But I only say that because they exist today, right? It might move on to be something that doesn't exist today. And the kind of the hopeful endpoint actually is that once all of that has been sufficiently built out, you can eventually just swap away from RGB or taproot assets or whatever, or whatever that is still in some sense on chain, because they are like actual, they're asset issuance protocols basically. You can just get rid of them entirely and have it be ecash instead. which is what ecash is like kind of for. And I always hesitate to say what, a technology is for, because it's like, it's a tool. It's whatever, it's for whatever the people using it want it to be for. But I kind of feel like in this case, ecash is so deliberately constrained, and also just with reference to its actual historical development outside of Bitcoin too. Obviously, it wasn't designed with Lightning in mind, but this is now, again, credit someone else who's massively influenced my thinking on this, probably massively influenced everybody's thinking. This is like Callie's whole argument about it, like why he got interested in it, why he's devoted so much time and energy to developing it, that the original Chaumian blueprint basically just doesn't work on fiat because you need so much permission, right? It's like, what's interesting about it in the first place is how permissionless it makes the cash, and yet you need permission to run it, so it just breaks. Whereas you can do it on Bitcoin, and obviously I think ecash for, which is Bitcoin denominated, is fundamentally a lot more interesting. But to round off the thesis, I do think that's like the final state of stablecoins before hopefully fiat just disappears altogether. I think is ecash routed over Lightning.
And so there are kind of two different components of the kind of like stablecoin, like after reading your piece, the direction it moves with, or I should say two different fronts that it's kind of like fighting on like for Bitcoin is what it kind of looks like from the technical aspect that you just talked about. But then there's also the aspect of, I mean, when I saw the Genius Act passed and everyone's like excited, and I'm like, if this is actually adopted, and you mentioned this in the piece, it's a fully reserved banking system.
Mm-hmm.
And so how does that disrupt a fractional reserve system? Can they coexist together?
I hesitate to give too confident an answer on this because I feel like there's an obvious ideological pull towards, yes, all the fractional reserve banks will go bankrupt and we will save the world, right? Or something kind of similarly silly to that effect. And I think the truer answer, the more honest answer, is really just some variation of I don't know, because ultimately what that tension, like how that tension will be resolved, I think will just be in the market of the consumer in this case, which is like the depositor, right? And I really don't know. I don't think anybody knows. I don't think any prediction on this should really be taken very seriously. I don't know what all depositors in whatever banking, so, presumably the US, right? Given we're talking about the Genius Act, just like 300 million people. I don't know what they're going to do. I don't know what they're going to value. I do think it's exciting. This is the point I make in the piece, that on the margin, it's exciting that people who are sufficiently into all of this can now kind of opt out in a sense, right? They, for the first time since, I don't even know. I mean, maybe in the case of the US, in the case of the dollar, arguably just ever, like they can actually have a provably 100% backed dollar. But even there, when you say like 100%, like backed by what? Backed by T-bills, which are free. So like even that's like, no, I don't know. It's this is what I was alluding to before when I forget how I said it, but something like, to whatever extent we even still have fiat or need fiat. Like I find it difficult to get that excited by this, because as soon as you start exactly that train of thought, right? It's like, oh yeah, we can have fully reserved banking where it's fully reserved by meaningless promises from the government. Like, great. That's so much better than what we have now. And it's like, it comes with surveillance as well. Amazing. So sorry, I didn't really answer the question. I kind of meandered around it, but it's I almost feel like the tone of my answer here is more important than the actual content. I just like whatever, Genius Act, sure. Have fun with your stablecoins.
Yeah, exactly. And I mean, it's not like the government is going ahead and FDIC insuring these stablecoins, because that might, if it's, if somebody's presented with the option of FDIC insured stablecoin and fractionally reserved it doesn't seem like there would be any sort of reason why you'd keep your like everyday money
Yeah.
in a fractional reserve system.
Yeah. There's also one thing worth flagging, actually. This doesn't really have anything to do with Bitcoin, but there's a risk of getting too excited about this, in particular on ideological grounds, and not recognizing it's quite a strong centralization pressure. Because if, say that's true, right? Say that there's, back to the way I originally articulated it, that I don't know, but it just, in fact, turns out a lot of people care about this, and they actually are quite educated on fractional reserve and fully reserved and so on. And they make they have the realization that you just articulated. Probably the way that manifests in the market is that it's smaller regional community, like in the US at least, given the way that the banking system there is structured, it's smaller regional community banks that are forced insolvent this way because it's their customers rather than like JP Morgan's customers and Wells Fargo's customers who recognize this danger. And maybe even more to the point, I mean, I don't have any kind of inside scoop on this, but it seems natural. This is the way that it would develop. Your tiny little community bank in wherever is significantly less likely to launch a stablecoin than JP Morgan is. So it's probably, even aside from the, assuming you're educated enough to look into the stability of the banks, which probably hardly anybody is. If you're just looking at the market and it's like, well, what stablecoin do I want? I probably want the JP Morgan stablecoin because, first and foremost, it exists and my one doesn't have one of these things. So I think that's like, people can risk getting too excited by that too. It could just be an unfortunate centralization pressure in the end.
Yeah, no doubt. And I want to make sure that I give you if there was anything we didn't get a chance to talk about, because I know we're coming up on time. I want to make sure that you have a chance to expand on an idea or anything like that. Is there anything you wish I asked you about?
I don't think so. I mean, there's a whole bunch of things we could talk about, but we could go for like 6 hours. So no, this was really good. Thanks.
Yeah. I wish, no doubt. Well, yeah, just if you could just let people know where they can find you and the work you've been up to, that would be great.
Sure. Yeah. So for Axiom, the URL is AXIOM BTC.capital. So it's Axiom BTC.capital. It's the same handle on Twitter. So just Axiom BTC. And then for me personally on Twitter, it's Allen, ALLEN F32. So Allen F32.
Awesome. Well, so great chatting with you, Allen. Yeah, really appreciate it.
Yeah. Thanks, Timo. Appreciate being on.
Take care.